Hello, everyone, and welcome to our regular monthly feature, The Situation. I am joined by my co-host, John Pasalis, president and broker of Realosophy Realty. And as usual, every month for this feature, John is going to be answering in some detail the questions that we're getting from consumers across the GTA. Hi, John.
Hello, everyone, and joining us again.
So each month we select 4 to 5 questions from the many that John gets so that we can show a real timely range of the kinds of questions we're hearing from consumers in the market right now. You can send your own questions to askjohn@movesmartly.com. But John, if people have more specific situations that they want to talk about in their own cases that they need to share a lot more detail, I understand that they can also meet with you.
Yeah, 100%. I mean, for people who have more specific questions, or if you're a buyer or seller looking at getting more active in the housing market in Toronto, wanted to meet with me, one of my agents, you can always just go to movesmartly.com/meetjohn or send me an email at askjohn@movesmartly. And of course, we'd be happy to set up a consultation, a no obligation consultation.
Right. So hopefully a lot of you hear your answers here, and please feel free to reach out to John for more information if you need it. Okay, let's start with our first question. Now, a lot of these questions are really detailed, John, so you're going to have to follow me. All right. Hi, John. I've been a younger millennial reader for a few years now, and I was part of the COVID GTA exodus when my wife and I bought a house in the Kawartha area a couple years ago. I was wondering if Realosophy had more insights into the pre-construction market. I have not found any blogs or journals with heavy data like your team does about all things real estate. My question is, we are now looking at buying a pre-con in the GTA area. I would love to hear about the pros and cons of doing so in a time of relatively high interest rates. Kind regards, Stefanos.
A good question, a difficult one. Interesting to hear that they were part of the COVID exodus and now we're looking at buying in Toronto. I guess the first question, of course, is, are they looking at buying a condominium to live in or as an investment? I think those are very different considerations.
Right.
Both the type of building that you're looking at, the price you're paying, the layouts, like all of those factors are important. Now, I think what matters in either situation is really the price you're paying. And I think this is a lot of, one thing I think a lot of buyers don't realize. They look at the past and they look at everyone who made so much money off of pre-construction condos and assume that this is almost like a guaranteed lottery ticket that's going to pay off. And they don't realize that depending on the market, depending on the situations, the risk is a lot greater. And today happens to be one of those periods where the risk is a lot greater. So just for those people who are not familiar with the pre-construction condo market, I'm going to say condominiums. I'm assuming they mean condominiums, not houses in the GTA. It's a far smaller pool of pre-con homes.
That's right, John. What is the split in the GTA?
Actually, I don't have that thought. It's relatively low. The number of low-rise homes that are selling. Again, they're also more expensive, of course.
Right.
So usually, the pre-con condos are a way for people to find something a little bit more affordable. Now, the one challenge with the pre-con condo market is that the prices for pre-construction condos are generally anywhere from 30 to 35 or maybe even 40% above existing relatively recently built resale condominiums in the same area. And these aren't my stats. This is from a company called Urbanation, which basically does analysis of condominium markets. So, when they look at these numbers, they're not comparing, the pre-con building to the condo that was built 30 years ago. They're basically looking at saying, okay, what has been recently built and how do those prices compare? So as an example, like a condo, that was recently built and is selling now in the resale market for $1,000 a square foot. Well, you would be maybe paying $1,300 a square foot for a pre-con across the street, right? Now, the question, of course, is, well, why are people paying so much more for pre-construction condominiums rather than resale condominiums? Partly they've been decent investments because prices have been rising and you can leverage them a lot more than you can with resale condominiums, meaning the deposit structure is usually lower and spread out over a longer period of time. So when you think about your investment return, the investment return is just based on what you've actually invested. And if that investment is lower, like if your condo's gone up 200 grand and you've invested 200 as deposits, well, you've doubled your money. But if you've only invested 50,000 in deposits, I mean, you've made 4 times your money, right? And this is why condos with low deposit structures are very, very popular. Now,
and let's break that down. Sorry, John, for a second.
Yeah.
So what you're saying is when you're buying from the builder directly, you're paying according to a deposit schedule.
Yeah.
And you're only going to pay that amount. And then when the unit is completed in 3, 4, or 5 years, you then go out and get a mortgage, presumably if you need one, which most people do, to then finance the rest of the price of that condo. If you're actually buying a resale condo, which is just a listing on the MLS for an existing condo unit, you're actually going out, having a mortgage, paying the full purchase price of that unit right up front.
Yeah, and thanks for clarifying it. Exactly. And you have to have usually a bigger down payment because you got to buy now, right? And that's why some people like pre-construction condos, because their down payment / deposit is spread out over 2 years, for example.
And can you give us an amount of the ranges of deposit amounts you're seeing right now? Like what is typical for pre-con?
It depends, anywhere from 20%, some could be as low as 10. Like they're usually lower if they're closer to completing the project, right? Mm-hmm. And they already have sold a decent number of units. So it depends on the builder and the timeline that you're buying, right? But
that's usually phased out over several months, not all up at once when you would buy a resale. Okay.
So but the one thing to keep in mind if you're buying pre-con right now is that, you're paying, let's just say 30% more than resale, which means in order for that investment to pay off, you are the investor expecting resale condominiums to appreciate over time, right? Because if prices stay flat and that existing condo that just got completed is selling for $1,000 a square foot, say, and your building finishes and you've paid $1,300 a square foot, well, how much are you realistically going to sell it for to make a profit? You need resale prices to go up to justify the higher price for your building, right? And the challenge, I say the one thing is in the past, that was always a given. Like prices in Toronto generally have been rising for 20 years. Prices have been trending up. Over the next few years, it's less certain how quickly prices will increase, right? So if resale condo prices don't increase, you just run the risk that when your condo is completed, it's not worth what you paid for it, right? Because resale prices haven't kept up. And this, quite frankly, is the problem. A lot of people who invested and bought pre-construction low-rise homes, so semis, detached, and so on, just before the peak of the market, because what has happened with those is they paid, first quarter 2022 prices or December 2021 prices, which were near the peak. And now those homes are worth less than what they paid for them. And they're going to have a hard time getting a mortgage on those properties. So these are the risks that you have when you buy pre-construction condominiums. I'm risk averse. I probably wouldn't be doing it. Like I would not want all of my savings in my financial future to just be based on the whims and the volatility of the housing market. So for me, it's too risky to bet. But if you have a ton of money and you're a gambler, I mean, to each their own, I suppose.
Well, is that true if Stefanos is looking at this as an end use situation as well? Yeah. Does the same hold true? 100%. So, or is there a difference in
same thing,
whether he's just doing it as an investment?
Think about it this way. A lot of the people who bought those low-rise homes last year, right? Well, many of them bought them to live in them. Okay. And they paid, say, $1.5 million for a home that they're trying to get a mortgage on now that's only worth 1.2, right? And what the bank is saying, they're saying, great, you have 20% down, but we're going to do the 20% based on what we think the home is worth today, which is 1.2. And you actually have to have another $300,000 in cash to cover the difference between what you paid for it and what it's worth today, right? And that's what makes pre-construction very different from buying resale, even as an investment. Because or as a principal residence, if I bought a resale home for 1.5 million and the price fell to 1.2, I don't default, I don't declare bankruptcy, I just as long as I can keep paying my mortgage and I can sit in that house, I can wait for the markets to recover. But pre-construction is a bit unique because you're committing to buying it at a price and you don't know what the value is by the time you need to take possession. And usually it goes up. That's why people buy pre-construction. But if you happen to be in a market where it's not worth more, you have to have that money to make up the difference. Otherwise, you default on the purchase and the bank can sue you and you lose the deposit and all sorts of problems can come up.
And presumably, it's the high interest rates is why things have changed. All those incredible gains that a lot of pre-con buyers made in appreciation happened in an era of exceptionally low interest rates like we've seen in the last 15 years. If rates are not expected to come down that quickly, is that why you're saying it's likely that you will not see that type of price acceleration? You'll just see naturally less demand as a function of those rates?
Exactly. And I think that's what people are worried about, that, we might hit this phase where, prices, let's ignore the fact that maybe prices might decline next year or later this year or wherever. That's a possibility itself. But even if they don't, some economists are just predicting relatively flat prices. And again, partly because not just rates are so high, that home prices are still so high, right? We're still way above the pre-COVID prices that we were at, and home prices pre-COVID were high, right? So we're still well above that, and interest rates are over 5%, right? So I do think that's one of the reasons why I guess a lot of people who look at the housing market don't expect to see sort of rapid growth in prices as long as rates stay this elevated.
So what I'm hearing from you is the pre-con bet, which always had inherent risks to it because of the nature of it versus purchasing resale, was always a risky proposition. It was a cost analysis benefit that was maybe worth taking over the last 15 years because of the low rate environments. But when things turn like this, it really becomes important to assess that the benefits and the risks again. And now's a time when maybe you really want to take the risks seriously.
Yeah, and you're right. And it's a good way of summarizing it. Those risks existed before. They were there 5 or 6 years ago, but the economic environment was very different. I mean, again, we had so many factors that were stimulating and pushing prices up. Now there are a lot of forces, both economically and interest rates, that might keep prices a little bit more flat, I would say. And you're right. So the risks are elevated a lot higher today than they were, 3-4 years ago.
And a final question I have for you: if something stays flat rather than decreasing, would Stefanos find himself in the same amount of risk? Is it because any sudden movement you could find yourself in a pocket, let's say, of a 6-month downturn due to some outside influence, like we're seeing right now? It's less mitigated than in a time when you're seeing a lot of appreciation. So even if there are a few dips, your overall appreciation can overcome it. But now you're in a situation where if we're thinking about flat prices for a long time, the slightest downturn cannot be recovered from.
Yeah, kind of. Yeah. And you're still at risk because you've just paid $1.3 million for a condo when a newly built one across the street selling you're paying $1,300 a square foot, for example, for a brand new condo, when newly built ones across the street are selling for $1,000 a foot, right? So if prices stay flat in the resale market, how do you justify charging more when your building's done? And yeah, you could say maybe we're worth a little bit more because it's a newer building. But are you worth 30? You would need it to be worth more than 30% because you need to recover your transaction costs, buying, selling, closing costs, builder fees, agent fees to even break even.
Right. The pre-construction premium has to be made up.
Yeah,
and
exactly.
in a flat environment, of course, that is very much at risk to begin with. Okay. That's really clear. Hope that helps, Stefanos. Next question here. Hello, I am a real estate investor who has a few low-rise investment properties around the GTA. Due to the change in market trends, including, I think this writer is saying, which has resulted in very high prices for low-rise units, I decided to try investing in condos. In the spring of 2022, I signed up for a pre-construction condo unit in the Mississauga Square 1 area with a closing date set for January 2026. The condo is 720 square feet, excluding the balcony. It has 2 bedrooms, 2 washrooms, a parking spot, and a locker. I bought it for $965,000. Is this overpriced? Part 1. And then part 2, do you think the value of the condo unit will increase by the time it's ready for occupancy in January 2026? Wow.
So
magic ball time.
So this is actually a very similar question to the one we just had, and very similar considerations. And in many ways, a good kind of real life example. So this condo was purchased, doing the math just in my head, probably like in the $1,300 plus a square foot price range. We're in, where's it, Mississauga? Where was it?
In the Square One Mississauga area.
Okay, so resale condos that are newly built around that area might be $1,000 a square foot. Older ones might be in the $800 to $900 a square foot. So again, this investor paid a 30+% premium over existing resale. So the first question, is it overpriced? It depends on what your benchmark is. It's probably priced the way most pre-construction condos are, which is at a premium over existing resale. Now, will the value increase by the time it's ready for occupancy? Well, what does it needs to appreciate by for me to make a decent amount of money? At least 15%, I would think, so investors are banking that $1,300 square foot condo they got pre-construction today might be worth $1,500 a square foot in 5 or 6 years. Well, how likely is that if existing newly built resale are 1,000, right? Are existing newly resale condos in the next 4 or 5 years going to accelerate enough to justify a high enough price for that? I don't have the answer to that. And like I said, for me, it's just too risky of an investment. I wouldn't be doing it, but again, all the power to the investors who are, and I wish them luck. But yeah, it's definitely a riskier time to be buying those types of properties. So
to follow up on this question from Irina, I think I failed to mention that, and I am in fact using pseudonyms so that we can protect the identities of the askers. What do you suggest they might do in this case where they've already bought it at that price and now have concerns about occupancy in 2026? What can one do in this situation?
Well, when you say what can they do, what do you mean? Like they've committed to buying it?
Yes, if there's a concern that the price will be a lot lower when the resale units, for example, or it will not have allowed them to get a mortgage for the price they paid or something like that. But what would your suggestion be, I guess, in that case? I'm not sure that is the case here. They may have enough cash to deal with that. But
yeah, no, that's a good question. And some people have been asking these questions. And what I've been hearing is some people who bought recently have been trying to get out of their contracts. And, they're basically going to the builders and saying, listen, I bought this, I changed my mind, I want out. And in most cases, there is some penalty. You know what I mean? The builder doesn't just let you walk away, obviously. But for some people, they're willing to lose X $1,000 today because that loss is pretty much capped. Whereas, if they stay into it and they're worried the prices will not reach the level that they need, their losses could be a lot higher. Again, that's just a personal decision, I guess, based on people's risk tolerance and how much capital they have. Because if you have a ton of money and for sure that you can close, even if prices are down, then hold on to it for the next 15 years, right? Because
that's a more longer term issue. But this person's asking about occupancy. So I think what you're saying is if you are concerned about that, there is something about that, and maybe you need to get financing, start getting in touch with the builders right away, right now. Yep. Okay. Thanks. Let's move on to question 3. Hi, John. A friend of mine bought a property with the intention to finish the basement and rent it out. After the purchase, he realized that the property is zoned as R1 zoning, so he cannot legally make a separate unit. Could you please explain zoning codes? Also, whose fault is this? Do realtors have to know these zoning codes and their meaning? Thanks, Elena. Now, Elena doesn't specify what municipality they're in, so perhaps we can just assume City of Toronto, or is there a difference across?
So, I mean, I'll touch on this at a high level. I'm not a planner, so I'm not going to get into the details, but at a high level, I'll tell you this. Every municipality has their own codes, right? And the zoning codes largely outline what can be built in a particular area. Like R1 zoning, for example, in the Toronto area, generally is just pretty much detached homes. You can't build duplexes and triplexes. You can't build semis. You can't build townhomes, you know? So the zoning codes really outline what you can build. And depending on the different municipalities you're in, whether or not you can build a basement apartment depends on the codes. And even if they allow it, they might have some restrictions regarding parking and other requirements. So it's important to do your due diligence. Now, I mean, the question of whose fault is this? Do realtors have to know these codes? I mean, listen, I think if the buyer communicates that's to the realtor, I do think the agent has an obligation to at least advise the buyer and tell them where to look. Most agents are not experts on zoning, like zoning and planning and all of that. Like, and I'll give you an even better example. Like basement apartments is a relatively easy one, but garden suites, okay, and laneway suites is a new thing that's going on where, you know, if you buy a property, depending on the municipality and the rules and the lot size, you could build a garden suite, which is effectively a small home behind your existing home, right? And sure, like some realtors might know the very basic criteria for that, but they're not experts, and you should never be leaning on them because there are so many nuances to what is involved between the setbacks and the lot coverage and the density, and depending on how far the garden suite would be from the lot lines and to the existing home, you might need the second floor to have an angular plane, meaning it's not straight. It's like the roof is almost on an angle. Agents are not going to know that stuff, right? And quite frankly, most agents include in their agreements of purchase and sale a clause that says that the buyer and the seller don't hold the agent responsible for things like zoning, planning, building, construction advice. And that's why they do that. So on the one hand, yes, the agent should be advising their client and kind of putting them in the right direction and kind of giving them some basic info, but they're not going to be able to tell them everything when it comes to sort of a municipality zoning requirements, depending on certain types of renovations or changes someone wants to do.
But given that, I would expect a good realtor to at least tell me, okay, you know, you are interested in doing X. They should be telling you, you should get in contact with the municipal planning office. And I understand that there's often an analyst assigned or a planner assigned to very small units, even within areas. You should get in touch with the person responsible for your area and make inquiries. Is that fair?
Yeah, 100%. Yes, they should do that. And sometimes when we have clients who are very serious about doing that, like we'll refer them out to either a planner or a construction advisor, someone who's more experienced that could advise them more specifically on the specific property that they're looking at, right?
Right. Because I understand also the rules aren't always completely cut and dry. There could be a situation in your area in which it may be allowed because of some policy objective, or it may not be allowed, even if it's generally allowed elsewhere. So it isn't really a yes/no thing. You really want to be able to, you know, learn where you should be going, what you should be thinking, so that you can assess your risks properly.
100%. Yep.
And there are a lot of planner and construction consultants that work in the GTS?
I mean, there are, and I mean, most agents should have someone that they could refer someone to, especially if they're looking at doing, but again, I think in some cases, like you want to try to zero in on the areas that are a good fit. And then you have these people, once you start finding homes that you think have potential, and get more specific advice based on the type of work you want to do and renovations you want to do and stuff like that.
Right. I mean, how easy is it if you just consider buying a property to locate the city planner responsible for that area to try and pin them to an answer?
I wouldn't get a city planner. You'd want to have like your own advisor, consultant, or someone that you can call sort of real time that, you know, based on the type of property you're looking at. and give you just a preliminary assessment. Like I've had clients who look at, for example, like a garden suites, right? And they would have advisors who they can send and we would know generally this lot works, right?
Mm-hmm.
But when it comes to the specifics of exactly how much you can build, the square footage over how many floors, the angular plan, all that stuff, they needed to get a quick second opinion from someone, right? And if you have someone that you lean on, that's when they would get involved. Kind of like once you zeroed in on one or two properties that you're really interested in, before you make that leap and commit to a contract, getting that sort of last minute opinion.
Okay, from a consultant. Because if you relied on waiting for someone at the city to get back to you, I'm hearing
you're not going to. Yeah, no, that's not the best approach.
They're not there to handle those kind of volumes
and they would questions. Exactly. Yeah.
Yes, and they would prioritize projects that are under application.
Yeah.
So, okay, that's good to know. Okay, so I think we're on question 4 here. Hi, John. I think a substantial amount of mortgage holders will need to pay much higher monthly mortgage payments, maybe by thousands, in the next few years as their mortgage renewals come up. Could this trigger forced sales and increase the housing supply in the market? What do you think the impact on Toronto home prices will be in coming years? Thanks and regards, Karen. This is something that we're hearing is very likely to be a possibility.
Yeah, 100%. And we've been hearing that. So, over this year, I mean, we're already starting to hear about more homes basically hitting the market as power of sale. So power of sale is effectively when the banks take over the property and sell it. And the banks, list them on the MLS. They have to get the maximum price, but this can contribute to, of course, increase in supply. Now, right now, it's not a ton of inventory that we're seeing. Like, it's not like we're seeing a flood of people who are defaulting. The most people that are vulnerable are certainly people who had private mortgages, because those are mortgages that, renew every 1 or 2 years. And, in some cases, when the renewals are coming up, those buyers can't basically renew with the same lender, or that lender doesn't want to renew them and are forcing them to sell. We have not seen a ton of distress. And it's, to me, it's really interesting. And I think, okay, here's the thing. There's a number of reasons why I haven't seen a lot of distress. Number one, a lot of people on 5-year mortgages, right? So they have not been forced to experience this rate increase. Even people on variable mortgages, the way variable mortgages work in Canada, at least out of the 4 to the 5 big banks, even as the rate increases, your payment is static. It does not change. What changes is the portion of that payment that goes towards interest, right? And as variable rates have increased, anyone who bought a home, say in the past year, I would say virtually all of their mortgage payment now is interest because rates have increased so much, right? Now, Scotiabank is the one bank that actually increases your mortgage payment as the variable rate increases, right? And what's interesting is we have not heard about a ton of distress. Like, and in many ways, this is like the segment of homeowners that are experiencing this rate hike, this payment shock, because every Bank of Canada rate hike, their mortgage payment goes up, and if you had a mortgage for $3,000, well, now it's going to be $4,500, right? And I know people have Scotiabank variable rate mortgages. And what's interesting is many of them are just finding a way to make it work, right? And which is what most people are going to do when it's a family home, for example. Like, they're just going to cut everything out. So we haven't seen a ton of distress. Now, if the rates stay this elevated over the longer term, and I think this is where the market becomes more vulnerable, because people can hang on for 6 months or 9 months or a year, right? I mean, if rates stay this high for the long term, the longer they stay high, the more vulnerable people get, because again, the weight of these additional payments start weighing on people. And certainly some people who are, highly leveraged are going to have challenges. I think I mentioned on Twitter, I offered an anecdote, and I think this is a good one because it kind of tells you how some people think. I mean, I was picking up some food from a neighborhood restaurant, and one of the restaurateurs was, talking to me about his mortgage payment that went up from, I think, 3,000 to 4,500. And he said, well, that's not as bad as my friend who has 5 investment properties, right? And he said, not only does he have 5 investment properties and he's seeing his mortgage payment goes up, he has second mortgages on many of them. And now he's trying to get a line of credit on his home to use to pay for the increase in the mortgage payments on his investment properties, right? So this is like taking on debt to pay debt, right? It's crazy. I mean, and this is certainly the market we're in now, where people wants to hang on. And this is part of it is fueled by, if you have 5 properties, you look at what they were all worth at the peak. No one wants today's prices. They want Feb 2022 prices. So the combination of, the loss aversion that kind of influences people's decisions, combined with this, overly optimistic view that the market's going to turn around and the Bank of Canada is going to cut rates, is what's driving a lot of the people making these decisions. And this is a very good example of this person can hang on for a certain period of time, but at some point the debt runs out and you can't use debt to pay more debt. That well will run dry. And I don't know when that is. And the bigger question is, we don't know if the number of those people is going to be significant enough to overwhelm the market with inventory, the way it did during the US financial crisis. Most experts do not think that's going to be the case. So most experts think we're going to see an increase in distressed selling and in power sales and all that 100%. Most people do not think it's going to be like the volumes we saw in the US during the financial crisis, when people were just walking away from mortgages. So again, we'll see. No one knows for sure, but again, my instinct is we'll see it, but probably not in the volume that some people, think might materialize.
Right. And for more information on that, Karen, you might want to check out my recent interview with Rob Butler, a mortgage expert who's also an expert on the U.S. Financial crisis and what happened with mortgages there. And his assessment was like yours, John. I think he said the private lending environment might be 1% to 2% across Canada. Now, he said those can be concentrated in certain metro markets. Mm-hmm. So that's a question about whether certain, even areas or pockets could be more affected. But again, the type of walking away, distressed selling that we saw in 2008, which in the US resulted in price drops, without question. He's not really predicting, but he invited me to chat again in three months so we can see. For sure. I'm going to take him up on that. So we'll keep track of that. All right. I'm going to move on to our last question, and it's got many moving parts.
All right.
Are you ready?
Ready.
All right. Okay. Hi, John. My wife and I love your content. We've been desperately watching for just over a year now, trying to get the best of insight and advice on this crazy market. Thank you for all you do. Here's our situation. We bought a 2-bedroom condo in LaSalle, Ontario. I believe that's just beside Windsor, or a suburb of Windsor, in early 2019 as a future rental property. We decided to live in it and travel like crazy before having kids. But obviously due to COVID, that didn't happen. And I guess since then they've had 2 boys and are outgrowing the condo fast. So it looks like they use their time in another way.
Oh my.
We've been on the hunt for a single family detached primary residence, but we're also considering buying a slightly roomier property to live in now that we could rent out later when we can get into the primary residence we want. We don't want to get rid of our first condo, as I believe it will be a great extra income for us. We've pulled out $80,000 in equity from this condo for a down payment for a primary residence. Now, we'd love to get in our primary residence sooner. So we're also considering building instead of buying, as finding anything we actually like is near impossible due to the lack of supply right now. And if we're going to spend that kind of money, we want something we love. We're just having a really hard time pulling the trigger on anything with these high prices and high interest rates. Needless to say, we're at our wits' end and are desperate for some personal advice. My guess is, based on today's market and the situation, based on today's market and the situation I've described, what is your best advice for our next move? Do we buy a slightly bigger property to live in now and rent out later? Or do we sell our current condo and build or buy a primary residence now, or just wait? I'm not sure we can wait more than a year in this condo. Looking forward to hearing you. Thank you, Yannick.
What a great story.
We're laughing with you.
So of course, a lot to unpack with this one. And, I think the first thing I would say is that, and I actually get a number of people, I've had a couple of calls in the past month from people who are very similar situations that have properties, they don't want to sell them, they want to buy a home here, they want to keep their current as an investment property. This, of course, is one of the biggest trends in the GTA. No one wants to sell their home. And for valid reason. I mean, it's been a fantastic investment, right? Now, here's the thing. You have to decide what your top priority is when it comes to real estate. And by that, I mean, the top priority is either you want the kind of home that you can live in for the long term, or the top priority is you want to be a real estate investor, okay? And yeah, you may be able to do two, but one of them is going to take precedent over the other, and depending on your needs. And I'll give you an example. I had a client of mine who were renting a condo with 3 kids, and the condo was like 850 square feet, and they owned 2 or 3 triplexes. So they had real estate investments and were doing very well. And those investments have made money. And eventually they moved into one of them as their principal residence. But the point, that wasn't the original plan. The original plan was just to have 3 triplexes and they were going to rent. And this is a good example of someone who valued having investments and having them for the long term and didn't need the big detached home and the big backyard, right? That's not everybody, of course, right? So it's hard, it's extremely hard to get everything that you want in your long-term principal residence and maintain a portfolio of investment properties. It's very hard to do. So if you're not finding what you want in a principal residence, well, you have to make a very difficult decision. You're either selling your current property so you can use that capital to buy a home, or you're not buying the home you want. And I would not be buying another short-term rental condo. Like that is not a solution. Like you don't want to, because whatever you're buying, you want to hold on to for the long term. So if you want to buy a slightly larger condo that you're going to live in for 2 or 3 years, and you're fine keeping it for 10, and are fine if that means you cannot afford your own detached home in the future and will just rent something, that's fine, right? But you don't want to buy a small condo as a stepping stone for 2 or 3 years that you're going to have to sell in 2 or 3 years because you want to buy your main house. So you have to kind of decide which approach. So you're either going to, like I said, sell your condo and just say, I'm going to use that money, I'm going to buy my house for the long term. And then at some point, maybe you buy again. Like that's the thing. It's not like you have to invest now. It has to be now or never. And then if you buy, the other question, of course, is do you buy an existing home or do you build, right? I mean, in this, if someone is not experienced with building, you needs to be very cautious because building can bring up a lot of risks, right? And I mean, I'll tell you a personal anecdote because I think it's hilarious. I mean, my family, I manage most of what they do, but my mother at one point wanted to build. It was kind of part of her. She had this dream home she wanted to build. It was part of her retirement vision, and so on and so forth. And she had all these plans. And she would walk me through what her architects and her designers were telling her, but telling her to budget. And I was like, it's not possible. Like, it's not possible. Like the numbers they're giving you based on, and I knew like the types of quality it's just not possible. And given the type of project that they were looking at, there were a lot of risks. It wasn't just like building a home on a vacant lot. Like without any details, it was a more complex construction project, and I basically had to tell her, listen, if you want to do it, knock yourself out, but don't call me. if you go bankrupt and you lose everything and you're stressed out, like, don't put your stress on me, because I know that that's likely what's going to happen. Because if you get into a project that's over your head, once you're in, like, it's very hard to pull out. You know, if you start getting into the project and costs start running up and you don't have that capital, you're bankrupt. You have to sell a half-finished project as a distressed sale, which is incredibly hard to sell. You know, so I don't like getting involved with that. Like, if I'm very risk averse, I don't want to do that. And listen, that's not to say all projects are like that, but you just need to be very careful. And I've seen people do renovations where things don't go as they were expecting, right? And they need.
And what about zoning, John? Sometimes people don't get what they're planning. And
as we talked about earlier, yes. And that's another consideration, whether you can even build what you want to build, you know, but beyond that, you know, just mitigating the risk in the construction process is a very big thing. And you have to have a ton of money and capital to do that, because if you don't, you're getting construction financing, which is at very high rates. So there are risks in building. So I wouldn't recommend it if you don't have a ton of money. So, you know, if you're going to buy, I would probably buy a resale property or a newly built home or something like that rather than build. So I hope that answers it. I mean, and again, like I said, it's not to say that you have to do that. If this, you know, if this person wants to be an investor and is fine renting their home, they can rent a detached home and buy another investment property, right? I mean, some people don't like that because there's less certainty when you're renting a home. You might get, you know, kicked out after 2 or 3 years if the investor wants to sell it. But, you know, that's just the cost of, you know, prioritizing investment properties if you want to be an investor. So I'd say that's the thing. I think the key is just finding out what the top priority is and then making a decision based on that.
Decide who you want to be.
That's it.
That sounds like very good advice. Thanks, John. That was excellent. So thanks to all of you for your excellent questions. Again, you can get in touch at askjohn@movesmartly.com. You can also see our show notes here to get in touch with John if you have more detailed questions about your own situation. And other than that, I think it's just left for us to say thank you. Keep your questions coming. Thank you for listening and watching. And John, you'll be back next month.
I will. Yeah. Thank you. Thank you all for the questions. These are great. I mean, they help us think, and it's great to be able to discuss them on our show every month.
Yes. I mean, I do feel for people when I hear about such complex situations, but I take heart from the fact that if you do ask the questions early enough and decide to do something about, you know, a potentially really difficult situation, it looks like there can be some room to maneuver before things get, you know, to a point where you're really stuck. So I hope that people are taking that message away as the market suddenly turns and people find themselves in a lot different situation than we were in even a year ago. So,
exactly.
Yeah. So reach out and let us know what's going on. Thank you, everyone.
All right. Thanks, everyone.